As you hear this report from Steve about the minutes, is there anything in there that surprised you? It certainly sounds like fly hawks fly.
Yep, it's very much in line with expectations. The Fed is very focused on bringing inflation back down to target. And I would take it one step further. It's not just a matter of tightening as the labor market slows down. It is a matter of tightening precisely to slow the labor market down. They need to keep going till they break the labor market, because that's what it's going to take to bring wage inflation down. And that's what it's going to take to bring services inflation back under control, because, of course, services are very labor intensive.
I'm going to ask Rick Santelli to answer this question. Then, Aditya, I'll come back to you and maybe get Steve to chime in as well. There obviously is concern about a hot labor market and wage price inflation, a wage price cycle. Is that the principal cause of the inflation we're experiencing right now? I realize it's one of them, but it seems like we have forgotten that an influx of liquidity took place in the years immediately before this inflation. We had incredible fiscal stimulus. We had tax cuts, we had a huge amount of spending, and we had a Fed that was gassing it by buying securities and sending cash into the marketplace. Is this liquidity driven, or is it wage driven more? What do you say?
I think it's more liquidity, but there is some wage component here. The problem, or the issue, I should say, Tyler, is the Fed is going to always seem to side with the wage argument, in my opinion, but they need to be careful. Okay, if we look at the last report that we had for jobs, the August jobs report, month over month, average hourly earnings were up 0.3, Tyler, and year over year up 5.2. Why do I bring that up? Because 5.2 is definitely making a fall from its March extreme of 5.6. And just in July, we were up 0.5 on the month over month. So I see some of the wage pressures mitigating to some extent. But you're right. There's two areas that are going to be super sticky, maybe three. Okay, I think wages ultimately, but food and energy as well. And I think the latter, listen, I'm not going to get into a political debate. The latter, let's say we're going to get on track somehow, and we're going to build refineries and be able to bring enough to the marketplace to keep prices in a more reasonable spectrum. But that isn't going to solve what's going on in Europe or what's going on with Asia. So you're going to see a global fungibility factor keep those prices much higher. I think that everybody's missing the elephant in the room, and that is global slowness is going to cause many entities, whether it's the UN or other heads of central banks, to point to the one glaring issue that's causing them pain, the dollar. The dollar is up 18.5% year to date, and that is playing havoc with outside economies.
Well, Aditya, let me get you to react, before I bring Morgan in, let me get you to react to what Rick just said. Bring in the dollar, bring in the idea that are we really suffering the pains of wage inflation, or are we suffering the pains of something of that plus something else, namely a vast influx of liquidity?
I don't think the two are mutually independent. Fiscal stimulus injected liquidity into the economy, and that supported demand, which in turn supported the labor market recovery. Now we have a red-hot labor market fueled by both that strength in demand as well as the supply issues from many workers leaving the labor force, and that created price inflation. So I don't think we need to think about the two independently. They have both driven wage inflation and price inflation. In terms of the dollar, that's probably a bit of a headwind for inflation, obviously, because it lowers imported price inflation.